Hi everyone, today we're going to be talking about some S corporations. Now an S corporation is a little bit unique in its formation and how it's formed. So you actually have two options. You can either form an LLC or a traditional C Corp. And then what you do is you make a tax election to be taxed as an S corporation. So basically, if you form an LLC, you're all that's really changing if you're an S Corp is the way that you're actually taxed. You're still legally obligated to the same obligations as an LLC or a C corporation. The differences is obviously if you form an LLC, then you don't have all the administrative overhead of a corporation. But you still get the tax advantages of an S Corp and the pass-through advantages. So who can form an LLC? Now there are some, not an LLC, sorry, S Corps. Now there are some restrictions around S corporations and who can form one and things like that. For example, you have to be a citizen of the United States or legal resident of the United States to be a founder or an owner of an S corporation. There is a limit to the number of owners. You can only have up to 100 owners, and none of those owners can be corporations. They have to be all individuals and some selected trusts. So it's very limiting in who can actually form an S corporation. And so none of the owners can be like other LLCs or other corporations or anything like that. They all have to be individuals. And on top of it, they can't have more than one class of stock. If you remember, C corporations could have multiple classes of stock, whether it's common stock, preferred stock, and things like that. With an S corp, you can only have one class of stock. And there's also restrictions in what kind of industries can and can't have an S corporation. So, for example, financial institutions, insurance companies, domestic international sales, corporations and things like that can't actually be an S corp, or rather make that election to be taxed as an S corporation. Also, the state of Tennessee does not recognize S corporation tax. So if you are in Tennessee and you form either an LLC or a regular corporation, C corporation, and you make this election to be taxed on the federal level as this S corporation, however you chose to originally form your company will be how you are taxed on the state level in Tennessee. So if you formed an LLC and you're the only member of that LLC, you're going to be taxed it'll flow through your personal income, and you'll still be taxed as a regular LLC on the state level. On the federal level, you'll still be an S corp, and same with a C corp. You'll still pay state taxes on the corporate level, not on the individual level. So some advantages to one of the main advantages to S corporations is the tax advantages. There's not a lot of other advantages that the S corp has over either an LLC or a C corp other than the tax. So we're gonna jump right in there and go right into that tax. So we're gonna start off with an example. And in this example, we're gonna say that you had some net income for the year of $100,000. Okay, what that's going to do, and so if you remember, an S corporation or a C corporation, this $100K would automatically be taxed at 21%, and the corporation would pay $21,000 in taxes in federal income taxes. For an LLC or a partnership or any other kind of entity, this would flow through and be put onto your regular 1040 tax or income tax bracket, and you'd actually end up paying, as the owner, you'd end up paying 15.3% for the self-employment plus whatever tax bracket you're in, whether that's 10, 12, 22, 24%. So with an S corp, you kind of avoid that. You kind of get the best of both worlds. So in this example, what we're going to do, and another qualification with an S corp is you have to pay yourself a reasonable salary if you elect to become an S corp. So shareholders or owners of an S corporation who also work for that corporation have to pay themselves quote unquote a reasonable salary. What does that mean? Well, that means you kind of look at a lot of different aspects of the business and kind of determine what a reasonable salary would be. You don't want to get in trouble by doing some weird things. So we'll get into that at the end. But for now, let's kind of walk through this. So for example, we're gonna pay ourselves a wage, and in our case, we're gonna say that our salary or wage is gonna be $50K as the owner. Okay, now automatically, now our profit's down to $50,000 because 100 minus 50 is 50. But the corporation, because you're on payroll, you're actually going to end up paying payroll taxes. And payroll taxes in this instance, including everything, I've already done the calculation in the back end, but it's going to be $4,125. Which then leaves us with a true net income of $45,875. My math is wrong. I'm sorry, but this is what I'm going with. So that's where this is, and this actually flows through onto your personal 1040, on your personal income tax. So when we look at that. That's kind of what we have left over. Now we're going to make the assumption. What's kind of interesting about an S corporation is we have this extra money here, and this is going to be the net income for the business. But we're going to assume we're doing an all cash kind of business. There's nothing else. It's all cash. So what you can do in an S corporation that is unique is you can actually take this full 45 and you can pass that through as a distribution. To the owners. Now, when you are doing distributions, they have to follow the percentages. In LLCs, you can have unbalanced distributions, meaning one owner can take a $10,000 distribution, another can take a $2,000 distribution, even if they're splitting profits and losses 50-50. Now, in an S corporation, you can't do that. If you own 50% of the stock and a partner owns 50% of the stock, the distribution has to be split 50-50, matching those ownership shares percentages. You can't give one more than the other for this distribution. Now, as a wage, yeah, you might want to come up and say, okay, well, he does something different than I do, and when we look at the industries that we're both in, say he's a marketer guy and you're the CEO sales guy or something, you would look at those two pays across multiples and kind of say, okay, well, he gets X and I get Y, and that can be different, and that's totally fine. But the distributions need to be proportional to the ownership percentages. So what we're going to do then is we're actually, back to our example then, is these are all going to flow through to your 1040 again. So you're going to have your $50K in wages plus your $45,000 in distributions. And we're just going to assume this is a single member LLC, single member S corporation, so he owns everything, or she. And so really the income for this person is going to be $95,875, which is pretty good. So I would like to get that. Anyway, and so as we're going to kind of switch gears now. So this is for the S corporation. They're gonna file everything above that 95. So they're gonna file a return, an 1120S form. And it's going to have this information on it. It's going to have their net income, their expenses, who the owners are, the various wages they're going to get, and any kind of distribution that was sent out. And that's going to be filed on Form S20, and then from there, this S20 will go through, and you'll get a Schedule K, which goes through under the 1040 of the owners. Okay. And this Schedule K will allocate and say, okay, well, in his Schedule K, you'll also get from the corporation a W-2. Which will have your wage information. The Schedule K will have the pass-through information, including your amounts, your proportion of the distribution. Okay, so I think we've covered that. So what I'm going to do is we're going to start now and look at the personal income taxes, because on the business side, there is no business tax form except 1120, which is just an informational return. But as an owner, remember, you got to be looking for the Schedule K from that and your W-2 from that. So that's something that's a little unique with S corporations. You actually get two forms from tax forms you got to look at the end of the year. Your W-2, which if you're a regular employee, that's just normal. But a Schedule K is the unique thing that you have to get. All right, so we're gonna look now at the personal income tax and how that's taxed as an owner of an S corporation. So, like we said, his total income was $875,000. Okay, which that's a pretty good income amount. Now, with the Tax Cuts and Jobs Act of 2017, the standard deduction, we're not going to go into all of the details. That could be a what's that other one called? Not the standard deduction. Sorry, I'm having a brain moment here. Anyway, so we're just going to assume that they're going to elect the standard deduction, and this guy's married or she's married. Okay, so the standard deduction for 2019 is $24,400. And this is something you're going to take off. So immediately you're not going to be taxed on $24,000 of that, which really brings your taxable income down to $71,475, which is awesome, right? I mean, that's standard for everybody though. So if you're married and you don't have an S corp, or you're looking into other situations, you have income, this standard deduction is on your personal income tax return. So everybody gets that standard deduction if they're married filing jointly. It's different if you're single, or if you're filing separately. So again, this is married filing jointly for 2019. It does change now from year to year. Okay, so basically, what you're going to be taxed on this $71,000. Which I believe puts you in the 12% bracket, and your tax, if you go run through the calculation, and we'll probably have another video on how to actually calculate how I come up with this number, but the tax in this situation is going to be $8,189. Okay, now if you didn't pay any taxes throughout the whole year, you're going to be in trouble. But luckily, you had W-2 wages, and often those W-2 wages, there's going to be mandatory withholding unless you have elected out of withholding. So you want to make sure that you didn't. Because if you come to the IRS and at the end of the year and you say, oh, I owe you $8,000, they're going to tack on an extra late fee and penalties and interest for not actually paying your taxes. So make sure you pay those. If you estimate and you think I'm going to make $100,000 just in this example, what you want to do then is you want to probably pay about $2,000 per quarter in estimated taxes, so that you don't get hit with those late fees. So that's what you would owe at the end of the year. That's kind of what your tax bill would come up as. But remember, you also throughout the year with your W-2 wages and things like that, there was also Social Security and Medicare that was taken out of your paycheck. And those are mandatory. You can't opt out of those unless you have certain special circumstances. But most of the people in the world, or in the United States, I should say, can't opt out of that. And so we're going to assume we didn't opt out. We couldn't. We're not a pastor or a religious leader or anything like that. We don't have any kind of moral. Well, we might have moral, but we're not going to get out. We're just going to say you couldn't opt out. And so really, throughout the year, you had an additional $3,825. Taken out for that. So this number is also referred to as your FICA and things like that. So already now your total tax is here, but remember the business also had their payroll taxes, right? So you had business payroll tax. Okay, and if you remember that number was $4,125, which really, if you add those up, that's the kind of the total tax that we've been talking about. So what is that? 12, 16, 8, let's see, 8, 9, 10, 11, 12, 13, $16,139. So that would be the total taxes between your personal and then the business. It would be $16,139. Now, when you compare that and you run these calculations through other entities, you'll actually find that you actually end up paying less taxes usually with S corporations than you otherwise would with with a regular C corporation or an S corp LLC. So one thing you do have to be careful though, like I mentioned earlier, you can't have more than one class of stock with an S corporation. Again, you form it just the same as you would like an an LLC or a C corporation, all you have to do is fill out form with the IRS. I think it's 2553 to elect to be taxed as an S corporation. And then in order to even qualify to be taxed as an S corporation, you can't have more than 100 owners. You have to be a legal citizen or a citizen of legal resident or a citizen of the United States, and you can only have one class of stock. There are some other restrictions that are a little more specific to industries. So if you have questions, please reach out to us. Again, financial institutions, insurance companies, and domestic international sales corporations, they can't be S corporations. They can't be elected to be taxed like this. So reach out to me and let me know if you have any questions, comments, concerns, and we'd be more than happy to walk through and do a comparison of the various taxes for you. Anyway, remember to like us on Facebook, follow us on Facebook, and subscribe to our YouTube channel. We just recently launched some other social media platforms, so look out for us on LinkedIn and Instagram. Thanks again, guys. Have a good one. Bye.